Rescuing a SIFI, halting a panic, the Barings crisis of 1890. Eugene White. The collapse of Northern Rock in 2007 and Bear Stearns, Lehman Brothers, and AIG in 2008 renewed the debate over how a lender of last resort should respond to a troubled, systemically important financial institution, SIFI. Based on research in the Bank of England archive, this post re-examines a crisis in 1890 when the bank, supported by central bank cooperation, rescued Baring Brothers and Company and quashed a banking panic and a currency crisis while mitigating moral hazard. This rescue is significant because it combined features similar to those mandated by recent UK, US, and European reforms to ensure an orderly liquidation of SIFIs and increase the accountability of senior management. Financial historians Bordeaux 1990, Schwartz 1986, and Bingen, Flandreau, and Ugolini 2012 have argued that when faced with a crisis in the 19th century, the Bank of England simply followed Bagot's rule to lend freely at a high rate to preserve market liquidity. This historical fact has lent support to policy recommendations to strictly follow Bagot in a crisis. By downplaying the rescue and treating the 1890 crisis as minor, Turner 2014, historians have overlooked its significance and that of its French precursor. Thus, they have missed important examples of successful preemptive intervention that limited damage to the economy and future risk-taking. Origins of the crisis. Among 19th century merchant investment British banks, Barings Brothers was second only to the Rothschilds. Preeminent in trade finance, Barings was tempted by the emerging South American markets. Serving as the leading investment bank for Argentina, Barings helped to channel £140 million of investment to Argentina between 1885 and 1890. This huge inflow contributed to inflation that, followed by a bad harvest and a coup, produced a sovereign debt crisis.